Welcome, it's Drew Blazik with Logos and Markets. And what we're going to do in this video, we're going to calculate the WACC for a company. We're not going to do just a basic problem here. What we're going to do is we're going to have a completed three-statement model. And from the three-statement model, which is going to have included the revenue schedule, the cost schedule, depreciation, income tax, debt, equity, and working capital, we're going to have a full model, and we're going to see if we can calculate the WACC from that. And when we have the WACC, well, you can use it for a few things. What we're going to do in this video, we're going to have a valuation method and see what this company is worth through the cash flows and the WACC that we produced. So let's kind of walk through the model, what we have. So this is going to be our weighted average cost of capital, what we're going to be looking at. And we want to calculate the WACC. We're going to compute the free cash flow, determine the enterprise value. Then we want to do the equity value. And then we can find what the stock price is. So I want to walk you through the model before we get started. So we have a fully completed sim model. This is the revenue schedule, cost schedule. We got the income statement, cost or cash flow, balance sheet, depreciation, income tax, working capital, debt, and equity. We have a full scenario page. We have base, best, and worst case scenario. And then we have our assumptions. Now in this assumptions page, we do have some extra values that I originally did not have in my model. So we're going to have the beta. We have our unlevered beta, which is if there is no debt, what is the beta? And we're going to calculate what would the beta be based on more debt if this company takes it on. We have the preferred required return, which is also the market input for preferred stock that we could find our valuation, but it's also the payout. We got the risk-free rate and the market risk premium. So let's get to our model. So the first thing what we want to do is we want to figure out what is the weights of the company. How much of the capital structure is equity, preferred stock, and debt. So this is what we want to calculate here. So the first thing we're looking at here is we're going to look at what is the valuation of equity. Now, this can be a bit easier than the other ones. The reason is we have, so common stock is pretty simple. So what I'm going to do, and it's just to show you how this works, is I attach the assumptions. So that's the stock price as of today for this company, and that's the shares outstanding. If you notice top left, I renamed them. So I named it shares outstanding, price. So a lot of the variables, we don't have to go to the assumptions page. We could just type it in. So we don't have to get confused of what we are selecting. So first thing we're going to do is go to common stock. So if we want to find the valuation of what this company is worth equity wise, we're going to take the price. Actually, I called it stock price. And then we're going to multiply that times shares outstanding. And if you notice, it's 364. What we want to do is we want to put this, we want smaller numbers. This is going to be in our millions. So I'm going to divide it by 1,000 to get us that. So it's going to be worth $364 million. Preferred stock. So what we're going to do with that, preferred stock's a bit different. It's consistent. So what we want to go, let's go to the financial model, and what we're going to go is go up to our preferred stock. And if you notice that our preferred stock on the balance sheet is consistent, it's 30 million, part of the equity portion of the balance sheet. So it's not changing. So what we're going to do, this is called a perpetuity. And we can find out exactly the cost of it, which is going to be in our assumptions page. We have that right there is preferred stocks 10%. But to calculate the valuation, this is going to be the perpetuity equation. What we want to know is what is the dividend paid out next period divided by the 10%. And to find out how much dividends we are paying out, let's go back to our financial model. So there's a bunch of areas we could find this. We can go up to the income statement. Actually, we can go to the cash flow statement, preferred dividend. I see that we are paying out $3 million per year of dividends. That's negative. because it's negative on the cash flow statement. I have it on the income statement. And then also where that dividend is going to be located is going to be on the equity schedule, all the way to the bottom. And I'm going to pull that number. We have a preferred amount. We have 30 million preferred stock, and then that's how much money we raised. And then we're paying a 10% dividend. That means we're paying 3 million per each year. There's no growth to it. So if we had a growth, I would add the Gordon growth model. But this is consistent. It's constant. So to find out the valuation of this, I took the dividends. So I took the dividend and I'm going to divide it by the preferred required return of 10%. And there's a bunch of ways we can calculate this. But this is going to give us our valuation of our preferred dividends, which is also the total valuation of dividends you saw on the balance sheet. But to do it properly, this is called a perpetuity equation. We take the dividends, the total dividends paid out, divided by the required return for preferred stock. Next, what we want to do is we're going to find the valuation of debt. Now, if you are used to a textbook example to find the valuation, well, the textbook is going to give you a coupon payment. It's going to give you the par value. It's going to give you how many years outstanding. Now, the problem with that, we have a bunch of bonds and debt is out. Now, we have 3 forms of debt on this financial model. So I'm going to make the assumption that the book value of debt is very similar to the market value of debt. The way debt changes, now equity changes a lot quicker. Equity is the price of the company, and that can change per day. Now, debt would only change if you have a dramatic change in the interest rate. That's where you see a major fluctuation in debt. So off our assumption, what we're going to do is I'm going to say, I'm going to take the total amount of debt. So let's hit the sum. I'm going to sum up, and we have to find out in the financial model, we want to go all the way up to the balance sheet. And this is where our debt's going to be. Now, what I'm going to do for our model here, I'm going to take the amount of debt that we project for the first projected year in this model is 2026. So I'm going to take the revolver. That's debt, a short-term debt. The revolver is typically for a shortfall of the company. If the company didn't make money, the revolver kicks in. And if we did make money and we had a balance in the revolver, we pay it back quick. And then I'm going to hit comma. And then I'm going to take our variable debt, comma, and then I'm going to take our fixed debt. And I'm going to close that bracket. Now, I want you to see really quick in this financial model is if I go up a little bit, this is the projected years from 26 to 30. This is the last 3 actual recorded years that's on the accounting aspect that's already been recorded. So when we're looking at this, what values do you take? Some people say, well, you got to take the average debt for the next 5 years. Well, I think the appropriate way to do this, since this is a projection and things change, you take the projected for next year because we are evaluating the company today. So I'm going to take just next year. Now, in this model, I'm going to go further and I'm going to look at what if we change that capital structure, and we can see the impact of WACC if we do change the capital structure. So let's do that. So what we have here, and I forgot how I originally did this, was if you want to see it this way, we can add in the variable debt. I'm going to do each individually. So we got the variable debt, the first projected year. I'm going to do the fixed debt. And variable debt means the interest rate can change year to year, month to month, and the fixed debt is fixed. And then we got the revolver. And in this model, I did was I summed those up, but I already added it there. So now we got the valuation. And now what we want to do is find out what is our total invested capital, which is common stock, equity, preferred stock, and debt. And I just want to emphasize one thing, and we'll see it later on. Preferred stock is not considered part of equity or debt. So that's going to be something that we're going to have separate when we calculate the debt to capital ratio, the equity to capital ratio. We have to make sure. So it's a little more difficult than you would in a normal textbook test bank question. Next, what we're going to do, I'm going to hit all equals, and I'm going to sum up all the market values of common equity, common stock, preferred stock, and debt. And then that's going to be our total invested capital is 571 million. So now what we can do is we can find the weights. We can find the weights of each part of our company of equity, debt, and preferred stock. So we're going to make this pretty quick. So I'm going to go equals, and I'm going to go to the common stock, and I'm going to divide it by the invested capital. That's the percentage. And before I'm going to hit enter, I'm going to hit function F4 because I want to freeze, make that an absolute. So when I drag it down, it's going to drag it to these cells, and it will not move this. So 63% equity, 5.3 preferred, and 31% of debt. So we got the weights. Now, that's a good learning lesson here. If you notice, when I dragged it down, it took a one of those borders with me on the way down. And what I'm going to do is I'm going to hit Control Z. If you ever make a mistake, hit Control Z. And what I'm going to do instead, I'm going to hit Control C. I'm going to copy, and I'm going to highlight those two, and I'm going to hit Alt ES. The Mac is a bit different. I do not remember how to do the Mac, but it's Alt ES for a special paste function. And I'm going to hit formulas. And then if I drag it down, it's not going to mess up the format. Oops. Sorry. It's not going to mess the format of our model here. So that's real important. So you hit Control C to copy, and then you can hit Alt ES. Next, what we want to do is we got the weights. We want to find out what is the cost. What's the cost of common stock, which is the most difficult to really come up with a good answer because it is more, it's not as precise as debt that we could do a simple calculation to find out the cost of debt. So what we're going to use in this example to find out the cost of equity is we're going to use the CAPM model, the capital asset pricing model. So I already have this in the assumptions, but I labeled them. I'm just going to show you real quick, but I'm not going to go to the assumptions. I already have names for it. So we got the risk. Here's our market assumptions. The risk-free rate, 4.5%. The risk premium is 8%. And then our beta right here is 1.4. So what we can do is I'm going to go equals. I'm going to say the risk-free rate, hit tab. And this is just the capital model. I'm going to say plus, and then it's going to be the beta. And then that's going to be multiplied times the market risk premium. And I think I just called it market premium. So our estimate, the cost of equity is going to be 15.6. Your cost of equity should always be higher than the cost of preferred stock and debt just because it's more risky and it has a larger deviation from the average, right? Debt is guaranteed you're going to get those interest payments unless it goes bankrupt. And even if the company goes bankrupt, the secured debt holders are the number one group of people that once we sell off the assets, they get paid back first. Common equity gets paid last, more risky. They require a higher required return. Got a couple more things I want to fill in here. I'm going to fill in taxes. I call that tax rate. That's going to be the 21%. Now we want to find out, well, what's the cost of preferred stock? Cost of preferred stock, well, that's pretty easy. It's in our assumption. The preferred required return, that's going to be that 10%. I'm going to bring that in. And in other words, if we issue new preferred stock, we, as the company, we have to pay 10% to the preferred holders. So that's the cost of that. Now we got debt. Now in your textbook examples, typically you'll have coupon payment, years, then we got MPER. And what we're trying to find out is what is the yield to maturity. Now in this example, we're going to look at a financial statement. We want to find out, well, what is our cost of debt? Well, our cost of debt must be the total interest that we're paying right? The interest could include coupon payments, could include just the par value and the price that we received. But we want to know what is the interest payments on the debt divided by the total debt outstanding. So we're going to do a sum function. So what we want to calculate first is all the interest payments. And what we're going to do is go to the financial model, and you want to think about, well, where is interest found on the financial model? The last two that we have is debt and equity on the bottom. It is the debt schedule. Now, this is important when we look at this. If I scroll all the way down, we have net interest expense, okay? Do I select this one? Most people say, yeah, just select the net interest expense. You do not want to select that if your model has the cost of debt plus the gain of cash, because on interest. So we have, if I scroll up to the top of this model, we have cash that we have on hand. We have a lot of money in this example, and we have an annual 1% we're getting back from cash, from holding on to cash. I included that for our net interest expense. So what I did was I added it up all the costs and I subtracted out this. So I do not want to include the net interest expense because it includes cash. So what we're going to do is I'm going to add up the three forms of debt. I have the fixed debt interest, which is right here. And then I'm going to say plus. Well, I did the sum function. This is important. If you do the sum function, hit comma. And then I'm going to do the variable interest expense, comma, and then we want to know what is the interest expense on the revolver. I'm going to close that up, and then I'm going to divide it by, and I'm going to hit sum. So I'm going to divide it by the sum of debt. So you could do a bunch of things. You could add up the sum of debt again. But one thing I could do, because we already summed up debt, was I'm going to delete that sum. Originally, that's how I did it, and I went back to the balance sheet and I added up the debt for the next projected year of 2026. But if you go back to our WACC function here, we have our, you can't see it, so I'm going to select there and I'm going to hit to the right. So I'm going to divide it by, I'm going to click on it real quick. Unfortunately, Excel, when the equations go crazy, it's hard to see. So what I did was I added up all the interest and I divided it by, we already have the debt, divided by 177 million. So that shows how much debt outstanding, and then we have all the interest payments. This will show at what interest rate it's going to cost us. All right, a couple more things we want to do. I'm going to bring in the long run growth. Oh, that's not popping up. Let me see something really quick on our assumptions. You know what? I think I put it down in our scenario page of 2.5. So what I'm going to do is go back to WACC. I'm going to hit equals. And this is just kind of explain it really quick before we go forward, because we need that value. Is in our scenario page, we're projecting out the cost growth, cost of inflation, how much it's going to be, and we have three different scenarios. I have a sales price scenario shown because we were making those projections, and also sales volume growth. And we have 2%, 3, or 4, or 5. But then after the projected years, we're going to make the assumption we have a 2.5 long run growth. We believe the company will grow at a perpetuity of 2.5%. So we want to make sure we bring that in. And then now what we have all the components. We can calculate the WACC. Now, one thing I want to emphasize, this cost of debt right here. Oh, now let me highlight it. The cost of debt is the before tax cost of debt. We need the after tax cost of debt because the cost of debt has a tax shield that we do not have to pay. Because if you think about the income statement, let me go to the income statement just to show this real quick. Those who are in finance probably know what I'm talking about. But when we look at EBIT, that's our earnings before interest and taxes. What we have is interest expense is taken out before taxes. So interest is not taxed. So what we want to do in the WACC is when we do this function, I want to make sure I multiply the debt, the before tax cost of debt, times 1 minus the tax rate. In other words, we get a 21% discount on it. That means 79% of the interest on our debt we have to pay. 79% have to pay, 21% discount. So we're going to go equals. So I'm going to take the weight of common equity and multiply it times the cost of common equity plus the weight of preferred stock, and I'm going to multiply it times the cost of preferred stock, and then I'm going to go plus the weight of debt, and I'm going to multiply that times the cost of debt, and then what I want to do with debt is multiply times 1 minus our tax rate. So that's going to give us our weighted average cost of debt. So there you go. That's how you calculate the weighted average cost of debt when it comes to the a financial model, rather than looking at simple questions that we'll have for a textbook question. What we wanted to calculate, well, if you have a fully financial model, how would you calculate that? That's one way that you can actually pull up a company's financials and do this method. A couple things I want to mention is that WACC is very important when it comes to the valuation methods, which we'll do next video. So I think this video is going to be a 3-part session or a 3-part series. And then also WACC is used to discount projects. So valuation of the company, and it also would be used, okay, if we want to do this new project and it's going to earn a certain amount, well, I want to find out what the net present value is, and that's when I'm going to use WACC. If I want to know IRR, the internal rate of return, I'm going to compare that to WACC. If it's greater than that, net present value is positive. So that's video number 1. We solved WACC, and then the next video, we will find out the valuation methods. I'll see you soon.